Always enjoy catching up with you, sir. We got a rotation back last week, but there's a big difference last week to the previous rotation we saw going into June. There was a huge reopening play. The data was picking up going into June. That's not the case this time around. What do you make of the move we saw last week and what you expect to see in the coming weeks, Bob?
I think churning and that bumpiness is likely to continue, John. It's not going to be a straight line. You know, when estimates were falling for everything but those big tech stocks, people just plowed into the big tech stocks. Now with the economy coming back, those earnings for those other companies are doing a bit better. So I don't think it's an either or. I think it's a both and. You've got to pick your names. And I think the economy, which initially saw a V, is now going to be a bumpier recovery. Not everything's going to turn on right away, and we're finding out some things that were turned on are going to be turned back off for a little while. It's going to be bumpy.
So, Bob, many people would come on this program and talk up active investing. Are you saying that we should just own the index and not try and trade this?
No, I think within both those camps, you can find good ones and not so good ones. For example, I don't like Netflix, but I like many of the others in that category. So you can be long one and short the other and make some alpha that way. Year to date, through June 30, the average active manager in large cap US equities actually beat the S&P 500. I think there'll be more of that to come. Stock selection's key.
Help us on the growth and the cyclical side then, Bob. What's the playbook, the guidebook for you to pick out the names that you want exposure to and the names you want to avoid?
So I want to make sure that they have got a balance sheet that can weather any storm. I'd love a cash flow story that's pretty interesting. You know, names like Target fit that bill. I think on disappointments where the fundamentals are good, like Bank of New York Mellon last week is another name in that category. So I'm not going to abandon my health care, my AbbVies and my United Healthcares, but I want some things that are geared a little more to the economy as well.
Just in terms of real yields and income, I wonder how important income's going to be and how important it is for you right now, Bob. Real yields in America, deeply negative. They have rolled over in the Treasury markets, aggressively so. What does that mean for what you want to own in the equity market?
I think, John, I want to own companies that have the cash flow, that can service any debt, can provide a dividend if they don't, or raise it. So it's more about the cash flow story than, you know, what is the dividend yield today, in my view. And I think that cash flow, the excess free cash flow, that's going to be a key statistic for making money in this market.
Bob, you sound far more nuanced than most guests on this program when we discuss some of the big themes like growth versus value, the US versus international. When it comes to size, small versus large, are you just as nuanced?
Yes, I am. It's a little from both columns. I mean, the small underperform by so much that they're now pretty cheap relative to the big. So you've got to sort through and go company by company. It's not the big, broad themes, in my view. Look, market went down 35%. We got 80% of it back. If we're in a churn environment, John, it's going to be what I own and what I don't own. And this week could be different from a month from now.